Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play, and I am joined by Jessica Inskip, our new Director of Education and Product here at Options Play, to talk about a topic that many of you here at First Trade have requested that we cover, which is the wheel strategy. And for many of you who are maybe not familiar with the wheel strategy, it really is the combination of two strategies that we have covered here before, which are cover calls and cash secured puts. But today, what we're going to talk about is the combination of those two strategies to complete the life cycle of buying an equity and then selling that equity, hopefully for at a profit. But doing so on both ends, the purchase and the sale of that equity position, whether that's a stock or ETF, utilizing options, which can embed an income stream into the purchase and the holding of your equity positions. Now, most of you here today probably have some stocks or ETFs that you own in your portfolio. So what we're going to do is talk about it in the context of purchasing those stocks and ETFs and the sale of those ETFs. So with that, what I'm going to do is pass this over to Jessica, who will kick off this session here today and give you a breakdown of the overall strategy, go through a real example, and then I'm going to come back here towards the end where we're going to discuss some of the best practices around the implementation of the strategy and the tools that are available to you here at First Trade and Options Play to help you implement what you're going to learn as from the strategy here today. So with that, Jessica, thank you so much for joining us today, and I'll pass the ball on to you.
Absolutely. Thank you, Tony. I'm happy to be here. I really enjoyed the presentation we did together last time, so I'm happy to build upon that. And this is a really great presentation that Tony and I spent a lot of time putting together that I think you'll really enjoy. So please feel free to type in questions along the way to make sure that we cover everything, and we'll ensure that we have adequate time at the end as well. Of course, before we get started, I do want to give you a very important disclaimer. Types these forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only, and examples do not include any commissions or fees. And Options Play is a third party not affiliated with First Trade in any way, shape, or form. Important disclaimer to go over. So let's go over what we're going to exactly cover today. So first on the agenda, we're just going to quickly go over what the wheel strategy is. I'll give you a good illustration of what it looks like and what it's essentially used for. Then we'll do a quick review of covered puts and calls, as that's what's utilized within this strategy, and how we shift that around in the wheel. We'll of course have lots of examples throughout, and then I'll pass it over to Tony, where we'll talk about optimal covered puts and calls and the tools and resources that you have available, as well as opportunity reports, and of course, trading tips and Q&A at the end. But what the real question that we want you to keep in mind that we're going to answer throughout this is, how can I maximize yield and participate in capital appreciation utilizing options? That's the heart of this strategy. That's what it's intended for. That's the beauty of options. You can layer them together and build strategies based on your outlook or how you feel about the security. And that's what we're going to do with the wheel strategy today. So what is the wheel strategy? So first of all, when you're selling options, you collect premium in exchange for an obligation. And when you have that obligation, for the put, it obligates you to buy the security. And for a call, it obligates you to sell the stock. So for the put, when it's below your strike, that obligation kicks in. And for the call, when it's above your strike, that obligation kicks in. So the goal of the wheel strategy is utilizing those obligations as entry and exit points or buy and sell points, allowing you to collect or create continuous income and collect premium along the way. So let me explain that a little more, what I mean. So when you sell a put and collect the premium, Your goal is to continuously do this until you're purchasing the security. So it needs to be expired or it's assigned, in which case you buy the stock. Once you buy the security, that's how you create the continuous income, is by selling the put on either end of the will. Once you purchase the security, that's done through assignment, and you then sell calls to collect premium against that security. So think about that for a moment. When you're selling a naked call or a naked put independently, so it's not covered by something, we call it covered because you're setting aside the cash that you need in order to buy the security, or you own the stock that you need to have as collateral to sell the call, which again, we're going to go into a lot more detail. But independently, you want those to expire. You want them to be worthless. You do not want them to be assigned. You do not want them to go up in value. You actually want to capitalize on that time value depletion, and you want to make sure they expire. With the wheel strategy, you actually utilize those obligations and you welcome assignment. You're okay with buying and selling the underlying security. It's essentially the intent of the strategy. So you utilize those obligations that are inherent with the short call and the short put to determine entry and exit points, very much like limit orders. So if you've ever purchased and sold a stock with a limit order, this is essentially the same thing in a way. However, you're maximizing income until it hits your limit price. And we'll talk about that in a little more detail. So in comparison to purchasing the underlying, you're reducing your risk and maximizing gain. So you sell puts and sell calls looking for assignment. That's how you create the continuous income. When you create that continuous income, you reduce your cost basis along the way. So if you're collecting a premium, it expires, you get $5 for selling something, and that you keep going in that cycle, you're going to purchase it at a lower price than you would if it was just a normal limit order. So that's how you purchase at a discount. And you also can participate in capital appreciation because you are owning a security. And anytime you own a stock, that kind of overwhelms every aspect of the strategy. And so these are both bullish, and we'll go into that when we look at the profit and loss diagrams and exactly what that means. So I know that this is explaining the wheel strategy right up front, and there is a lot that we just covered. I'm going to come back to this once we go through the examples and add some clarity, but this is essentially just an illustration that explains what you're looking for throughout this entire process of the wheel and where you are within the process. So let's quickly review a covered call. That's an important component of it. I'm starting with the call rather than the put, just from looking at the profit and loss diagrams. I think it's the way that I learned, so I'd love to share it that way. But when you're writing a short call, you sell the right to buy a certain amount of shares at a specified price within a specified time frame. So since you're the writer of that call, you're short that call, you have an obligation to buy at the buyer's discretion. So I use this analogy quite a bit, and I will probably use it quite often. But when talking about options, I like to think about being in a car and being a driver and a passenger. When you're long the option, you are the driver. When you are short the option, you are the passenger. As the driver, you dictate if you go left or right. But as the passenger, you can be aware of your surroundings and get a good idea if the driver is going to go left or right or stop or wherever they're going. But at the end of the day, it's the driver's decision. So the driver in the options scenario is the one that can say, I want to exercise my option. They are executing upon the terms of the contract, and the short option holder is obligated to meet the terms of that contract that they sold. So therefore, individually, they do not want that contract to have any value, whereas the long call holder wants it to go as high above the strike price as possible. That's something that certainly isn't unrealistic, but the short call holder is essentially on the other side of that. So what I have on this diagram here, this line represents owning a security. So this, if you were long 100 shares, this is the security that you own. When you sell a covered call, you actually cap the upward gain of that security, because you're saying, okay, if I buy Apple at $100 per share and I have the obligation to sell it at 110 through my short call, then you're capping your upward potential, because that option is going to have value as it goes above that strike price. And if you were to look at a naked call individually, this would actually be on the other side. And that's because individually it's a bearish strategy. By adding the long position, you actually create a neutral to bullish strategy, which is the beauty of the wheel strategy altogether. And a lot of questions we got on this one is, what happens if the stock goes a different direction? It's something that I want to make sure we cover up front. Is this strategy altogether is bullish. You do this on a stock that you want to own, and we'll go through that in a little more detail. So for a covered call, you have to own 100 shares of an optional stock or ETF. That is your collateral. You then sell a call option using those stocks and ETF as collateral, and in exchange, you receive a premium. So that's the premium that you receive. And you can see here, so the way these profit and loss diagrams work, this is when the stock goes up, this is the profit, and then down here is the loss. So this actually reduces your cost basis in exchange for capping upwards potential. So therefore, the covered call just creates an obligation to sell the stock or an ETF at a specific price. Now looking at the cash covered put, so this actually has a very similar, almost identical profit and loss diagram, because it's bullish. You make money if the underlying goes up, and that's the goal of it. So that's important to know. So a long put holder is on the other side. They have the right to sell at the strike price. Therefore, the short put holder has the obligation to buy at that price. So that's the obligation we're going to utilize within the wheel strategy. So in order to have a cash covered put, you have to have the cash readily available to buy the stock or ETF. Margin isn't required because of that reason. You are having something as collateral. You sell a put option utilizing that cash as collateral and receive a premium in exchange, in which case you've created an obligation to buy the stock or ETF at a specific price. So those two items are extremely important to understand, and those are the prerequisites going into the wheel strategy. So I want to make sure that was clearly covered. If you have any questions, I would love for you to put those in the chat right now to make sure they're covered. That way we've got you the entire way. All right. So let's look at a scenario, and I'm going to utilize ABC stock just to keep it evergreen here, but I'm going to look at this strategy through the eyes of someone who trades just stocks and someone who utilizes the wheel strategy. So looking at ABC here, you may do your due diligence and your technical analysis and decide, I want to buy this security for whatever reason it is. There's a lot of technical indicators flying off here that would give me indication that I would want to do that. Whatever your process is, you've decided I want to buy that security. That's step number one. From a person who's just trading a stock, you may say, I'm going to go ahead and put in a limit order at $50. I want to go ahead and buy ABC if it's at $50. So you're specifying a price. And then you've also specified a price target based on your technical analysis or whatever your process is, and decided once I buy that at $50, I actually have a price target of 58, and that's where I'm comfortable selling ABC. So essentially you're risking $5,000 altogether. So we're going to assume you're buying 100 shares and selling 100 shares for a reward of $800. So you're essentially looking for a 16% return. So I'm going to utilize this scenario and look at this through the eyes of someone who is just purely doing this from a stock perspective, and then from someone else who is utilizing stock and options and the wheel strategy. So day one, the stock investor placed that buy limit order for 100 shares of ABC at a $50 limit. So both started with $5,000 cash. They're debited $5,000 because that price was immediately hit, so it's executed. The stockholder has that security. The stock and options holder started with the same $5,000, but they sold to open one ABC $50 strike May 6th put at 3:15. Let's assume May 6th is approximately 30 days from now. That put contains the obligation to buy ABC at $50. And that obligation only comes in if ABC is below 50 at expiration, or if the long put holder decides to exercise. So in exchange for that, they were credited $315. So instantly, the stock trader was charged $5,000 and in exchange received 100 shares of ABC that's worth $5,000 right now. It's at $50. And the stock and options trader was credited $315. That $5,000 that they had in their account is sitting as collateral and attached to this options contract that contains the obligation to buy 100 ABC at 50. And what they've done is reduced their cost basis to $46.85. So essentially, by selling that option, they're doing almost the same thing in a way. There are definitely certainly different risks and rewards here, but there is a price specified with collateral attached. One is a limit order owning the security, the other is via an obligation. And the risk certainly comes in if ABC all of a sudden were to skyrocket past 315. Well, the ABC security, the stockholder will make more, whereas the stock and options trader will just simply keep the premium. So there is certainly risk and reward there, but the purpose of the strategy is continuous income and capital appreciation once you own the security. So let's see how this plays out within the next, until we get to expiration. So we go to day 30. ABC is now up $1 and up 2%. So the stock has made $100, percentage, dollar for dollar is up. The stock and options holder actually has an expired option contract. So this didn't go up above that 315, it went up $1. Therefore, it's expired. The put isn't worth anything. So remember, a put contains the right to sell. And if the market is pricing at a higher price than the put contains, it's not worth anything. So that's why it's considered worthless. But the stock and options trader in this case made 6% because they turned that 5,000 into 315, where the stock trader made 2% in this scenario. So since this expired, this is where we're going to stay in that wheel strategy on the upper right-hand side and write another put contract. So on day 33, and let's say 33 as in day 30 was that Friday, 33 is the Monday. So it's when you come back in and sell those puts again. The stock and options trader decided to sell to open an at the money put. So an ABC 51, another 30 days out for $3 this time. So they raised their obligation to buy price at this point and were credited $300. So this time there's $5,100 worth of their cash that's utilized as collateral, and they received another $300. So you can see how the premiums can certainly add up over time in comparison to the stock trader. And in this scenario, again, this cost basis was reduced. And the reason this wasn't reduced exactly by $3 is because we raised our buy price from 50 to 51. So it's reduced by 2 there. So going back to, or excuse me, forward to expiration, now let's say ABC actually went flat. So remember we were bullish on the security, and that's the core and heart of this. We want to ensure that you remain bullish in the security. That's an important component of it. But ABC went back to our starting point, is at $50 per share. Well, that's going to cause assignment because this put is worth value on the day of expiration. So remember, on expiration, options are normally worth only their intrinsic value, and all of that extrinsic is depleted, which means if there is value, then you're going to be automatically assigned through the exercise and assignment process. In this case, they were assigned that obligation to buy at $51 kicked in. So that was subtracted from their total cash. And now they own 100 shares of ABC at $5,000. But now that ABC is at our starting point, the stock trader is flat and they haven't realized anything. So they haven't sold the security. So there's still room for upwards potential or downwards. And the stock and options trader collected $515 worth of premium along the way. Because remember that the basis was raised $1 here. So therefore, they made about 10% on this transaction. So now that we own the security, the next step within the wheel strategy is to establish a selling point. So in order to establish a selling point, the stock trader is going to create a limit order to sell 100 shares of ABC at $58. So that's the price target that we talked about in the beginning. Since ABC is not at $58 right now, they have to specify that as collateral. So when you put in your limit order and you say you're going to sell the shares that you own, you can't do anything else with those shares. They are attached to that order. That way you don't end up shorting or something in your account. That is collateral utilized for that trade. The stock and options trader is going to do a very similar thing. You're going to say, okay, I want to sell at 55 and looking for 30 days out. That's where they're willing to sell based on the premiums they've brought in already and are credited $2. So with that credit of $2 in that contract that's created, they have the same collateral of their 100 shares of ABC that's worth $5,000 right now, and an obligation to sell those shares at $55 per share at the buyer's discretion, as in the long call holder's discretion. And they received $200 for that. So this is now where we're on the other side of the wheel. We're going to create that obligation to sell and continue to reduce our cost basis in order to capitalize on that upwards potential and capital appreciation is the point where we're at now. And we'll talk about optimal strikes and tools and resources, how to implement this in just a few. So going all the way to expiration now, we'll say that ABC now is at $52. Remember, the contract contains the right to buy at 55. 52 is less favorable than 55. So therefore, or excuse me, more favorable than 55. Therefore, this contract isn't worth anything. It makes more sense to go buy at the market at 52 than execute on the terms of the contract and buy at 55. Therefore, it's expired. That full $2 is credited. The options holder now releases their obligation, has 100 shares worth $5,200. So they've participated in that capital appreciation. Whereas the stockholder still has their limit order. Maybe they sat it there and left it, but also participated in that capital appreciation, making 4%. But the options holder or seller in this case has also sold premiums and capitalized on that. So now the total gain of the $5,000 is $815, collecting about 16%. So now we're going to go ahead and sell another contract. And this time, sell price is going to remain the same at 55 and receive a credit of $2 for this. So we have the same collateral. The stockholder hasn't changed at all, but the stock and options holder is receiving a credit of $2 for an obligation to sell at 55. So implemented that same obligation, just collecting a little more premium. So let's see what happens when we hit expiration. So let's say in expiration, our bullish thoughts and sentiments and technical analysis was very accurate, and ABC actually blew through our price target and is up $10 or 20% altogether. And mind you, these percentages and gains are based off of the original price, not day to day. So what's going to happen in both scenarios is, well, the stockholder had an open limit order to sell at 58. Once that bid is hit, it is executed, that collateral is gone. They're going to collect $5,800 worth of cash. The stock and options holder, they're going to be assigned, which means their obligation is kicked in. They'll sell those shares that they had as collateral, but at $55 per share, because that's where their obligation is. So the point of showing you this is there are essentially two obligations. There's one to sell at 58 and another to sell at 55. And those obligations exist as long as you keep them intact. So for the short option holder, as long as that remains open, and for a limit order, as long as it remains open, you have the option of closing both. So in this scenario, the stock and options holder made 28% and the stock trader made 16%. And the purpose of this is just to show you how utilizing that wheel or that strategy, it allows you to choose entry and exit points, but capitalize on collecting premiums and utilizing the obligation that options inherently have due to their composition along the way. And that's essentially the goal of it. So I'll bring you back to that slide before I hand it over to Tony. But hopefully that gave you a good idea of exactly how that's implemented. So you create continuous income by selling that put. And if it expires, it keeps going above your strike, which means you're right, you're bullish at that point. And that's why selecting optimal strikes and expirations are extremely important. But you're reducing your cost basis, or you're purchasing at a discount by doing that. And then essentially once the stock is assigned, so it's below the strike price at expiration or a little earlier, you buy the stock, which is something you're okay with, you welcome that. Once you own that security, then as it starts going up in value, you select optimal strikes and expirations based on your exit price or the strike price at which you're willing to sell. And then you do the same thing on this side. If it expires, you just keep doing that. And then if it's assigned, you reduce your cost basis even further along the way. But once it's assigned, you sell the security, and then you do it again as long as you're still bullish on that security. So with that, I'm going to hand it over to Tony to go over a very important part, which is how to choose optimal covered calls, optimal short puts, and of course, resources.
Thank you so much, Jess. That was a fantastic breakdown of the strategy from a conceptual perspective. Now let's take this one step further and look at actual examples. And I want to use a little bit of a thought experiment here just to get everyone thinking regarding these types of strategies now that you've learned it from a conceptual perspective, how to apply it to the next stock or the stock that you currently own in your portfolio. So let's first talk about covered calls. And I have a stock here, Cleveland-Cliffs. Many of you may currently own this stock in your portfolio, very popular stock of 2021 and becoming increasingly more popular here in 2022, especially as inflation continues to run at a very hot level. Some of these resource-based stocks are the ones that are seeing some significant upside. Cleveland-Cliffs, just this year alone, up over 100% here. Perhaps you own the stock and you're looking at selling some cover calls. And what I have here is a screenshot of where the stock was trading last week, trading around $30 or so. And I just want to have a thought experiment for those of you that are watching today. You've learned the strategy, you learned it from a conceptual perspective. But if you were looking at selling cover calls on this particular stock, I'd like to know, where would you choose to sell your cover calls? So the stock's currently trading just above $30 right now. Let's say you have a few choices, the 34 strike, 36 strike, and let's say the 38 strike, which I'm drawing lines on the chart. That tells you how far the stock needs to rally before the stock is called away. And for the $38 strike price, you're collecting 63 cents in income. The 36 strike, you're going to collect 94 cents in income. And the 34 strike, you're going to collect $1.41 in income. And the corresponding raw returns, meaning how much premium you're collecting as a percentage of the stock price, is shown to you here on the right-hand side. And the annualized return telling you how much the raw return would come out to be if you put them into annualized terms. So you have that data here on the right-hand side. And the question that I want to ask the audience here is, if you have this particular stock and you're looking at these three choices, which one would you choose? Type your answer into the chat window, the 34, the 36, or the 38. Which one would you choose when it comes to selling cover calls? 34, 36, or 38? I see a lot of 36 answers so far. I see quite a few 34s. So the answers are almost exclusively between 34 and 36. I see one or two 38s so far, but almost every single one of the answers so far is either 34 or 36. Now, I can certainly understand why most people will choose the 34s. It has a high amount of income, $1.41. Why would anyone want anything less than $1.41 if you can collect $1.41? And certainly these numbers here on the right look very enticing. I see a few 36, and I'm guessing a lot of people choose 36 because they see this as kind of the middle of the road. You're not at one end of the extreme, not too high, not too low. You're kind of somewhere in the middle. You find a more balanced approach to it. Well, what I can tell you is that we've researched this. We've back tested this over from 2007 to basically a few months ago. We've back tested this across all S&P 500 stocks, and we basically tested selling cover calls on every single possible expiration date and every single possible strike price to determine which parameters, which expiration date, which strike prices will yield the best results in the long run. And when I say best results in the long run, we're accounting for a few different things. We're accounting for how much income you collect on the cover call, but we're also accounting for how much capital appreciation do you have on the stock that you own? Because the reason that you own a stock is because you believe the stock is going to rally in the future. And what you're trying to do is wait for that to happen so that you can sell the stock in the future for a higher price and capture that as a profit, because you need to have that upside in order to justify the risk of owning that stock. So that's really a large component of why you own a stock. And it's important to factor that in when you think about selling cover calls. And this is something that a lot of investors tend to overlook because you're focused too much on income, too much on how much premium am I collecting. I want to collect $1.41 than 63 cents. Obviously, if anyone gave you the choice of saying, would you rather have $1.41 or 63 cents, you're going to say $1.41. But what's important to understand here is that the difference between these two numbers, 63 cents and $1.41, that's about 80 cents difference in income, right? So you're going to collect an extra 80 cents in income when you sell the 34 strike. But what are you giving up for that extra 80 cents? What you're giving up is exactly $4 for that. What you're basically saying is that I will trade off $4 in capital appreciation of the underlying stock in exchange for 80 cents. And ask yourself, is that a recipe that makes sense in the long run? May work for you this particular expiration cycle, may work for you the next expiration cycle, but that 1 month where out of the blue, the stock jumps significantly, maybe on earnings, maybe on news, maybe just the market is doing really well, and the stock rallies substantially. What would you rather have, an extra 80 cents, or would you rather have an extra $4 in capital appreciation? I think the answer should be fairly clear. And that's why, based on our research, every bit of information that we've done shows us that when you sell cover calls, you should sell calls that are relatively far away from the stock price that's going to collect actually lower amounts of income, because in the long run, what you're really after is that capital appreciation. The extra 80 cents is not worth it for you if you give up a significant chunk of the capital appreciation of the stock itself. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And this is the most important part about if there's nothing else that you take away from today's session, it's understanding how do you pick the proper expiration date and strike price for these cover calls. Generally speaking, 45 days out is the optimal expiration, but most important, the really low probability strike prices that are really far away from the stock price, those are the ones that you should shoot for. The income's going to be less, but that's okay, because when the stock rallies substantially, that's when you're going to have the true payoff, if you will, of these types of strategies. The 15 delta is referring to a strike price that has only a 15% chance the stock is going to be above that strike price at expiration. So 15 delta means 3 out of 20 cover calls that you sell where your stock is going to get called away. The other 17 times, you're going to keep the 63 cents. That's roughly what the 15 delta refers to, okay? So that's how you select cover calls. Now let's talk about short puts. Let's talk about a stock that you may want to purchase. You know, airline stocks haven't been doing so well. Oil prices are really high. Maybe you think that this is starting to turn around here and you think now's the time to start looking at some of these airline stocks as they get really beat down and the valuations look fairly attractive here. Let's take a look at the same thought experiment. American Airlines last week trading at about 16 and a half bucks. If I sold a $16 put, I'm going to collect 85 cents. If I sell the $15 put, I'm going to collect 52 cents. If I sell the $14 put, I collect 32 cents. And the corresponding raw returns and annualized returns are here on the right-hand side. So same thought experiment, the stock's trading at 16 and a half bucks. Which short put would you sell? Type your answer into the chat window. The 14, the 15, or the 16. Type your answer into the chat window. I see a few 14s. I see a few 16s. Predominantly, I see a lot of 14s. I'm guessing a lot of people learned from what we just talked about in the previous slide and are choosing the low probability trade, the 14 strike put. I see a couple of 16s, but mostly 14s. So this is really where we also did a lot of research, back testing this exact strategy across all S&P 500 stocks from 2007 to today. And overwhelming, the data shows us that the best strategy to use is actually the price, the strike price that is closest to the current price of the stock. And I'll talk a little bit about why. When you're looking to buy a stock, there's two things that you want to prioritize. If you sell a strike price that's this far away, let's say the $14 strike price, there's a pretty low probability that in the next 30 days, the stock will reach your stock price and that you will be exercised on that stock and that you will be able to participate in the capital appreciation in the future. So if you're not going to participate on that capital appreciation, right? So if let's say the stock dips a little bit and starts to take off, you miss out on all of this capital appreciation because you've chosen a strike price that's down here. Versus if you chose a strike price that's very close to the current price, you have a very high probability that the stock will be executed or you will be exercised on that stock and that you have the potential of participating in that future upside. And not to add to that, you are going to collect 85 cents or significantly higher annualized return on your cash that you're setting aside to potentially own that stock. So in the worst case scenario that the stock just takes off and never looks back, you at least have a fair amount of yield to show for the cash that you've set aside to try to own that stock. So for those reasons, when you're selling a cash secured put, you really want to prioritize both the probability of owning that stock and the yield that you are collecting while you wait to own that stock. So for those reasons, when you're selling cash secured puts, shorter dated 30-day out short puts and strike prices are very close to the current price are where you want to prioritize your research. Does that make sense? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so now that we've learned this from a conceptual perspective, now that we've learned some real examples with some practical knowledge as to how you go about implementing this strategy, let's take this one step further and show you how you can apply it to your actual portfolio with the tools available to you at First Trade. So what we have is a cover call opportunity report and a short put opportunity report where we actually do all of this work for you. So in the example I showed you, Cleveland Cliffs and American Airlines, those are prices from last week, right? So how do you apply them to the prices right now on the stocks that you either want to own in your portfolio or the stocks that you already own in your portfolio? That's where we generate a research report that you can find within your First Trade research and tools section. Under research and tools, there is an options section, and within the options section, there's both a cover call report and a short put report. And you can use it for exactly that. I'm going to show this to you on the First Trade website. So if you go to research and tools and you click on options, you have both a cover call and a short put report. And you can sort this by all different types of columns. You can sort it based on the stock price. You can sort it based on the raw return, the annualized return, the days to expiration. There's a lot of different things that you can use to sort this report. And it's designed to be very flexible so that you can quickly sort through this report and find the stocks that you want to sell cover calls on. So let's talk about actually short puts first, because that's the first part of a portfolio, or the first part of selling of the wheel strategy. And there's a few different ways that you can sort this. A lot of traders like to sort this report actually based on stock price, because you usually have a range as far as what you can afford 100 shares of, right? If you have a small account, you might only be able to afford 100 shares of stocks like Ford and American Airlines and Crown and Carnival Cruise, versus if you have a larger portfolio, you might be able to afford something a higher price. So you can usually sort it based on stock price and get a sense for that. You can also just sort it based on symbol. So if you want to have a specific symbol in mind that you want to take a look at, but we basically cover the full S&P 500 range. Any other stocks outside of the S&P 500 that we deem as liquid, including ETFs, are on this report. So basically any stock that you're looking to acquire, you can find potentially using this report. And I'm going to use a stock like Ford, a low price stock, just as an example. The stock is currently trading at $15.44. We're telling you to sell the $15 strike that expires on May 13th. That's going to generate, in this particular case, a 4.57% yield in the next 30 days. So this is the 30-day 40 delta strike price. And as you can see, the distance of the strike is about 2.8% below the current stock price, and then generates a yield of 55.58%. So it takes everything that we just taught you here today and shows you exactly which expiration date and strike price fits that optimal short put opportunity. And if this is a stock that you maybe are doing some analyst research on, and you've done your research and you believe that this is a good stock to purchase, then you can go ahead and hit the trade button, and it will pre-fill the order ticket for you to send this order into your First Trade account. We've made this process as easy as possible for you to be able to access the concept, the reports, and then potentially execute this trade if you are ready to place that trade. So for someone like myself, in order to sell a cash secured put, I will go through some of the trading tips as far as what I look for, but predominantly these are stocks that I'm familiar with. These are stocks that I want to invest in the long run, and making sure that I'm able to understand the obligations that I have when I sell that cash secured put. Because when I sell that cash secured put, I'm obligating myself to owning that stock. So you should do your research from a technical perspective. You should do your research from a fundamental perspective to understand, is this the stock that I want to own? And if it is, this report shows you how you can capture a discount on the stock purchase. Because for Ford, I can get a 4.57% discount on that stock purchase. Does that make sense to everyone? Please type 3 into the chat window if that makes sense to you, because the premium you collect in this particular case, roughly 70 cents in premium, that's going to give me a 70-cent discount on the stock purchase. So if I have a 70-cent discount on a $15 purchase, that comes out to 4.57%. Ask yourself, if you can get a 4.5% discount on every stock purchase you've made, how much does that yield you in the long run? The answer is that it's actually fairly significant. And that's really something that you want to look for as a stock purchaser. And then once you own that stock, you can come back to the cover call report and you can do the same thing. You can look for the stocks that you own. You can sort it based on the raw return or the annualized return and find stocks that yield a higher premium. And you can do this very quickly and see, I usually sort this based on symbol and just go down the list of stocks that I own. So let's say I own, let's say I own Bank of America. Now, Bank of America is a stock that yields a fair amount of yield, but as you can see, the annualized yield that I collect on Bank of America is 6.42%. The stock's currently trading at 38, selling the $44 strike price that expires in roughly 44 days. It yields me 6.42% annualized yield. Bank of America probably pays half of that in terms of its actual yield. So I'm basically doubling my yield by adding a cover call to this strategy. And this is something that you can utilize very quickly. So using the short put report to find stocks that you want to purchase and click on and selling cash secured puts and getting a discount on the purchase. And then once you've purchased that stock, turning that around, selling cover calls and generating usually double, sometimes triple, or even quadruple the dividend yield that you own on that holding by selling cover calls on top of that. And when you sell cover calls, you're really looking for a big rally, right? The stock's currently trading at 38.77. The stock has to rally to $44 in the next 44 days. That's a 13% rally in 45 days. If every stock that you own rallied 13% in a month and a half, you would probably be a very happy camper and you would be happy to take profits. And that's exactly what this strategy does, is that, in the unlikely event that the stock takes a very big move, an outsized move to the upside, you get to capture that and take profits from that. And if the stock doesn't happen to do that, you're going to collect an income yield that is roughly double, sometimes triple what you're getting from the dividend. So you're just adding additional yield to your portfolio, reducing your cost basis. And if that stock makes a big move one particular month, you can potentially take profits on that, take the profits from that, and roll it back into a cash secured put. That is why this strategy is called the wheel strategy. You purchase stocks at a discount, and then you hopefully sell that stock when it makes a big rally here to the upside. Once you have that rally, you take those profits and you reinvest it back into the wheel strategy. And you can do this all using the first trade report, and you do it just from this report alone. And you click on the trade button here on the right-hand side. It will pre-fill order ticket here at the bottom with everything: sell to open, the Bank of America $44 strike call option. And all you can do at that point is put in a limit price and send this trade off for execution. This is designed to try to make your experience of implementing the wheel strategy as simple as possible, as easy as possible using this tool. So with that, what I'll do is I'll go back to some of my trading tips here. When you're looking at this wheel strategy, the most important thing, generally speaking, is to focus on stocks that you're familiar with. Because when you're selling a cash secured put, you're investing a minimum of 100 shares of that stock. You should only buy 100 shares of stock that you want to own and stocks that you're familiar with. You should never do it just based on the yield basis alone. If you're trying to generate a high yield incoming portfolio, you want to sort it based on the raw return column of that report. And again, with a small account size, you sort it based on the stock price, focus on the lower price stocks. And the last thing to be aware of is the earnings flag. The earnings flag is also something we have on the report. As you can see, the earnings flag tells you whether there's an earnings before expiration or whether or not there's an earnings before expiration. So yes, if it's a Y, that means there's an earnings before expiration. If there's a no, meaning there's no earnings before expiration. Obviously, the ones with the with the no is preferable to ones with the yes. However, what you wanted to just look at is whether or not these two dates are close to each other. If the earnings are very close to the expiration date, I tend to be okay with that. But if the earnings date are just very close to today, so for example, you have Alcoa, which reports in just 7 days, right? So you still have 44 days to expiration, but it reports in 7 days. That's probably one that I might avoid. But if something expires, let's say this reports on May 12th and this expires on May 27th, I have still quite a bit of time to go and it's much closer to the expiration date. Airbnb, I'd be more inclined to sell a cover call in Airbnb because it doesn't report for a few more weeks, or in this particular case, a whole nother month. And by that time, I may be able to roll the strategy early or do something else along with that. But, I'm basically using this report to help me decide whether it's a trade that I want to make or not. And once I do, I can click on the trade button and have everything pre-filled for me here at the very bottom. And fill in my limit order and send this off for execution. So with that covers what I wanted to share with you here today. At this point, what I'll do is I'll bring Jessica back into the conversation here. And hopefully this was helpful in giving you a better understanding of the wheel strategy from a conceptual perspective. Jessica walked you through some real examples to hopefully help break down the strategy. And lastly, hopefully I was able to show you, the best practices and how to implement them using your first trade account. So with that, thank you so much for your time this afternoon. What we'll do is open this up for Q&A. You can type your questions into the Q&A section. There's a chat window and a Q&A section. If you don't mind, please type your questions into the Q&A section and we'll try to answer as many questions out of that section as possible before we sign off here for today. There's one question here from Cyril. Can we use the strategy for ETFs? And the answer is yes. You will not find as much premium in ETFs as you will for single stocks, but you absolutely can use this for ETFs, and ETFs are included in this report. So you do have ETFs in this report. It is not just stocks. So UNG, liquefied natural gas ETF is in here. You don't find many ETFs at the top of the list when it comes to raw return, but ETFs are here in this report. You have the TQs here, XME, these are all ETFs, and the XLY, these are ETFs, they're part of the report. Why is 30 days recommended for puts instead of weeklies? This is a really good question, Justin. And the answer is because if you sell weeklies, you're collecting very little premium per week. So if, let's say, you get assigned on that first week, you've got almost virtually no discount on the stock purchase, because you're just thinking it from the perspective, if I sold weekly options 4 weeks in a row, I'm going to collect more income than if I sold a 1-month option. But if you sell weekly options, you have 4 possibilities of getting assigned, and you have a pretty high probability of being assigned. So you're very unlikely to actually collect 4 or 5 weeks of income on if you sold weeklies. You're likely going to get exercised in the first 2 weeks, and now you own the stock for virtually no discount, because each week that goes by, you're collecting a very small portion of what you would out of a 1-month option. So for those reasons, you don't want to sell weeklies for short puts. Can you please share if you have any documented results of doing the wheel strategies on SPY? I do not, but that's not hard to find out, actually. I currently don't have any offhand. I will say, the major ETFs like SPY, QQQ, you're not going to get much of a, you're not going to get any significant income from those because those are fairly efficient and those are fairly well diversified. So you don't have a lot of volatility to generate off of that. Vincent, the optimal cover call is really in that 15 to 25 range. My preference is to get closer to 15. Our data clearly shows that 15 is the optimal delta on a cover call. There's a question about,
go ahead, Tony.
sorry, Jess, go ahead.
One question that was just earlier, for probability for being assigned isn't an issue. That's the goal with the wheel strategy. So when you're looking at delta, that's also utilized for probability of being in the money at expiration, which could equate to assignment. It is the goal of it. So it's not necessarily an issue because you want to own the security and you're bullish in this case.
Thank you. There was a question about IV rank. Well, what IV rank tells you is whether or not the implied volatility currently, or it tells you where the current implied volatility is relative to its previous 1-year history. And generally speaking, as a seller of volatility, which is what you're doing when you're selling a cash secured put or covered call, is you want to sell them on securities where the IV rank is high. The higher the IV rank, in theory, the higher the probability of success.
James has a great
question.
What can you do? Yep, same question, that
one. Yeah, what can you do when the stock price goes down big? That's a great question. What do you do when the stock price goes down big when you own the stock? You know, this doesn't change, right? Just because you sold the cash secured put or a cover call, you have the same decision, right? You buy stocks, whether you sell cover calls or cash secured puts on it is irrelevant. The question is, what do you do when the stock that you own goes down big? That's a decision you have to make for yourself, because it depends on what your, and the advice that I have for most investors is think about the opportunity cost. Yes, you can hold on to that stock hoping that eventually at some point in the future it's going to make its way back, right? But think about the amount of cash that you're tying up if you choose to do so. And could you do something better with that cash? That's really the question that you have to answer. You buy a $100 stock, it's now trading at 50 bucks. If you sold that stock for 50 bucks at a loss, could you use that 50 bucks to do something else with it that's better than holding on to that stock, hoping that's going to get back to break even? I tend to find most of the time, I will be able to find something better to do rather than hold on to that stock. But a lot of people have a tough time mentally taking a loss. And that's really what you have to get comfortable with as a trader, is that there's no such thing as wins and losses. It's really about being profitable in the long run. And that's a different conversation. That's a conversation around trading psychology and how to manage risk. But when you're selling cover calls and cash secured puts, if you bought a stock at 100 and is now trading at 50, if you didn't sell cover calls and cash secured puts, you would have a $50 loss. But if you did sell that, if you enter that stock with a cash secured put and you've been selling cover calls as you've owned that stock, maybe that loss is not a $50 loss, it's now a $40 loss. It doesn't fix the problem, it just makes the problem a little less painful. So it's really more of a question about opportunity costs and whether or not you think you could do something better with the remaining value of the stock rather than just continue to hold it. I tend to find that most of the time I am able to. And Jess, I'm sorry that I cut you off. If you have any other thoughts on that, please. I think the audience would love to hear that.
Yeah, no, beautifully covered. The only small item I would add is if it's going down significantly when you own the security and you're in the covered call phase of the wheel strategy, it's just super important to be cognizant of your break-even point. If you were to choose a strike price that is equivalent to or less than your break-even point, then you are guaranteeing a loss. So you just have to assess the situation. And that's why we started off in the beginning stating this is a bullish strategy. You do it on a security that you do want to own, and it goes into that same process if you were trading securities, like Tony said.
Thank you. That's a really good point to consider. Any other questions? Oh, it looks like there is a few. Chen is asking, why is the probability to assign isn't it on the report? It's not on the report because the probability of assignment on every single one of these on our reports are the same, right? So When we talk about cover call, the optimal cover call being a 15 delta, and there's a 15% chance of being assigned, what we're doing is we're choosing strike prices. Every single strike price that you see that's on this cover call report has a roughly 15% chance of being assigned, right? That's why we're choosing this specific strike price. And then everything on the short put report, every strike price you see here has a roughly 40% chance of assignment. That's why we choose the 40 delta. So that's why we don't have it, because it's the same for every single one on the report. Alexander saying, does high or low IV matter when entering cover call or cash secured positions? It doesn't matter. It's just that high IV, generally speaking, is preferable to selling cash secured puts and cover calls, or selling any of the option strategies. How do you handle when stocks move like AMD from 125 to 95? Again, same thing, right? You still have $95 worth of value. Do you think that that value is best continuing holding on to AMD, or do you think you have better opportunities in the market? Basically, the question is, do you think AMD will outperform the market going forward, or do you think that there are better opportunities in the market? I can't answer that question for you. That's a question that only you can answer. But that's really the question you should be asking yourself. You know, just because you take a loss doesn't mean you should hold. Just because the stock that you own has taken a loss does not mean that that stock will start to outperform in the future. Many times you tend to find that you have better opportunities in the market than continuing to hold on to a loser. Do you still sell puts when the stock is making lower lows? For the past few months, I've been stuck with selling calls. You know, I could argue that when stocks are making lower lows, those are some of the best times to sell puts, especially if you've identified a bottom. You know, if you think about it, you know, buy low, sell high, right? How do you buy low? You have to buy low when the stock is making new lows. The question is what method you go about determining whether or not this is the right time. You know, a lot of technicians or chart people who use charts or technical analysis will use that method to help them determine when something has exhausted to the downside. You know, there are many technical indicators that you can use. There are prior support and resistance levels that you can use. But those are some of the strategies that you would want to use. But making lower lows is considered some of the most optimal times to sell cash secured puts. You're buying low, and when stocks are making new lower lows, that's when implied volatility is the highest. That's when implied IV rank is the highest. That's when the puts that you sell will generate the most amount of discount. So it's a counterintuitive way of thinking, but counterintuitive ways of thinking is usually how you want to be in the markets. You know, think about like the famous quote from Warren Buffett: be greedy when everyone's fearful, be fearful when everyone's greedy. And this is exactly where, you know, you're being greedy when everyone's being fearful. Any other questions? Do you use spreads for further protection? So you can use spreads to protect yourself, right? So that is one way that you can protect yourself from a cash secured put, selling a put credit spread. But keep in mind that when you sell a put credit spread, you are significantly reducing the premium that you're collecting. So you might be collecting $5 on a $100 stock. When you sell a cash secured put, you might only collect about $1.30, $1.40, $1.50 when you sell a credit spread. So, you know, you're reducing your premium that you're collecting by sometimes 60 to 70%. But it does significantly reduce your overall risk. It also reduces the amount of margin or capital required to enter the trade. So it's a different form of calculus to determine that, but you have the same obligations as selling a cash secured put. Justin, you know, you're asking a tax question. Unfortunately, we're not tax experts. That is a question that you're going to unfortunately have to direct to someone with more tax expertise. With that, I think that covers all of the questions, and that is the time that we have here for today. Jessica, I want to thank you for taking your time here today. I want to thank everyone for taking the time out here this afternoon to listen to Jessica and I. We are very excited to be embarking on more education here for First Trade customers going forward every 2 weeks. Really excited to be continuing these types of sessions. This specific topic was based on feedback that you as viewers gave to us. So please feel free to continue to send in your feedback to the First Trade team, to us. Let us know what you want to learn about, and we will continue to incorporate those into the education experience. Jessica, any last words before we sign off here for today?
No, that's all. Thank you, everyone.
Thank you so much. Have a great trading day, and we'll see you guys back here in a couple of weeks.